Now let's discuss another question. So now the requirement of the question is, the first one is calculate the X right price per share. Second one is assuming equity finance is used, calculate the revised EPS after the business expansion. And the same requirement is connected with debt finance, calculate the revised EPS after the business expansion. And then after these two parts, we have to calculate revised share price under both equity option and debt financing. And then we have to evaluate whether debt financing or equity financing should be used for the business expansion. Now let's discuss the question. Tinco is planning an expansion of the business which will increase profit before interest and tax by 20%. The company is considering whether to use equity financing or debt financing to raise the 2 million needed by the expansion. So the requirement is we have to raise 2 million financing, and there are two options. One is the equity financing and other one is the debt financing. If equity finance is to be used, the option is a right issue 1:5 at a 20% discounted price to the current ex-dividend price of 5 per share. The nominal value of the share is $1 each. So the right issue price will be 5 into 80%, and that is 4. If debt financing is used, the company will issue 20,000 8% loan notes having a nominal value of $100 per loan note. So as a result, the amount that we will generate is 20,000 into 100 is equal to 2 million. The interest rate is 8%. Financial statement information given prior to new finance. PBIT is 1597. We have interest cost, taxation, profit after tax, and then ordinary shares of 2.5 million as par value is $1. So number of shares is the same as the value. So 7% loan note, there is already a loan note 4,500. The current price earning ratio is 12.5 times. Tax is payable at a rate of 22%. Companies undertaking the same business as Tinco have an average debt to equity ratio based on book value, that is book value of debt divided by book value of equity is 60.5%, and average interest coverage of 9 times. Now let's calculate X right price per share. So 1:5. So that means 5 existing shares. Current market price is 5. So we have 25. One right issue at a price of 4. So now we have 6 shares and the price is 29. So as a result, the price is 29/6. And 29/6 means 4.83. This is the X right price. This is the first requirement. Now for second requirement, in case of equity financing, what is the revised EPS after the business expansion? So for EPS, we have to find out profit after tax after expansion over the number of shares. So let's calculate profit after tax. So PBIT is given as 1597. And as a result of expansion, the profit will increase by 20%. So that means it's 1.20 and the value is now 1916. Finance cost, as a result of equity financing, there will be no change on the existing finance cost, which is 315. So Profit before tax is 1601. Taxation 22%, that is 352. And profit after tax is 1249. Now we need to calculate the number of shares after expansion. First of all, identify existing shares, and existing shares are 2.5 million. Right shares 1:5. That means 2.5 million divided by 5. So it's 500,000. And total number of shares is now 3 million or 3,000. Now EPS is profit after tax 1249 and number of shares is 3,000. As a result, the EPS is 1249, 3,000. It's 0.416. So EPS is 0.416. So it's 0.42 in case of equity financing. And in case of debt financing, now let's calculate profit again. PBIT will remain the same, that is 1916. You have to deduct now finance cost. Existing finance cost, we have 315. New financing cost as a result of this financing, 2 million into 8% per annum. And this will increase to 1,60,000. So profit before tax is 1441. Taxation at the rate of 22%. And now we have profit after tax of, in case of debt financing, there will be no change in number of shares, which is currently 2.5. So revised EPS is now 2500 and answer is 0.45. So EPS is 0.42 in case of equity financing and 0.42 in case of debt financing, 0.45. Now we need to calculate revised share price in both options. In case of equity financing, we have 0.42 multiplied by P ratio, which is given 12.5 times. So share price is revised 5.25. In case of debt financing, the EPS is 0.45. P ratio is same, assumed to be constant, 5.63. So revised share price is 5.63 and 5.25. Now use calculations to evaluate whether equity financing or debt financing should be used for the planned business expansion. We have been given the industry average of debt to equity ratio as well as the interest coverage ratio. So we'll calculate the same for this company in both options. So let's calculate gearing ratio. So first of all, identify current gearing ratio, then in the case of debt financing and in the case of equity financing. The formula that we need to use is debt divided by equity using the book values. So book value of debt, current debt book value is given as 4,500. And in case of equity financing, it will remain the same. And in case of debt financing, we'll raise 2 million. So that would be 6,500. And book value of equity. So existing book value of equity is 7,988. It's 7,988. In case of debt financing, the impact on equity will be increased by 2,000. So it's 9,989. And in case of debt financing, the book value of equity will remain the same. That is 7,988. Now, what is the ratio? Debt over equity. So current is 56.3. In case of debt financing, it's 81.4 percentage. And in case of equity financing is 45.1 percentage. Sector average is given 60.5%. So the current debt to equity ratio was below the sector average. But if we raise finance through debt financing, it is more than the industry average. And in case of equity financing, it is 45.1%. So in case of debt financing, there will be a rise in the gearing ratio, which might be a problem for the shareholders. Now the next one is interest coverage ratio. Formula is PBIT over interest. We can identify current, or in case of debt financing, or in case of equity financing. So first of all, what is my current PBIT? It's 1,597. Current interest, it's 315. In case of debt financing, the revised PBIT is 1916. It's 1916. Same in equity financing. In case of debt financing, the interest is now 475, and here it is 315. So the ratio is PBIT over interest. It's 5.1. In case of equity financing, it's 6.1. In case of debt financing, it is 4. And we have sector average 9 times. So in all cases, our ratio is current is less than 9 times. In case of equity financing, it is a bit improved. In case of debt financing, it's very low. So interest coverage ratio suggests that if you go for debt financing, it is not good for from the industry's point of view. As we know that in case of the debt financing, the share price is increased, while in case of equity financing, it's only 0.42. My current share price is 5.25. Current share price given in the question is 5. So in case of debt financing, compare this with 5. So we have a capital gain of 0.63. And in case of equity financing, $5.25 is the price, and we have 5. And after right issue, the price was We have to compare this with right issue price, which is 4.83. So 4.83, and we have 0.42 capital gain. So in terms of debt financing, we have a good capital gain, but the gearing ratio is not good, as well as there is a problem with interest coverage ratio. So on the whole, debt financing looks good in terms of share price, but not so attractive in terms of gearing ratio and in terms of interest coverage ratio. The last part of the question is, discuss two Islamic finance source which company should consider as an alternate to a right issue or a loan note issue. 6 marks. So 3 mark each. And this is a theoretical question. Two product. So here we can write two product which might be against the debt financing and kind of equity financing. One is Mudaraba. A Mudaraba is a contract between two persons where one person provides the capital and another person provides the expertise. So in case of equity financing, normally the shareholder provide you the money and the management use that money for the expansion or other purpose. In the case of Mudaraba, one is finance provider, other is expert. The business must be Sharia compliant. The profit will be shared as per an agreed ratio. Profit as per agreed ratio. In case of loss, it is to be borne by the provider of capital, not the party who is working against this. The provider of capital has to bear all the losses. While in case of an alternate to debt financing, we have Ijara, which might be an alternate to debt financing, or it might be a Sukuk. So let's talk about Sukuk. As we know that under Sharia principle, that conventional debt financing with interest is not allowed. So the alternate is the Sukuk. Sukuk is linked with the underlying tangible asset. And in case of investment against the Sukuk holder take risk and reward of ownership. Sometimes the Sukuk also has an equity aspect. Sukuk holder will bear the loss from the underlying asset. And Sukuk holder will generate income out of the asset, that is the underlying asset. So Sukuk alternate to debt finance. Sharing of risk and reward. No interest payment. Income from the underlying asset. Now let's talk about another topic, that is business valuation. So in business valuation, we need to identify the value of equity as well as the value of debt financing. For equity valuation, we normally use either the net based valuation, asset based valuation, sometimes earning based valuations, and sometimes cash flow based valuation. And if you have to calculate share price, so in case of the net asset based valuation, we have three versions. That is the historical cost, the net realizable value, or replacement cost. Simply use the formula, that is the value of equity is total assets minus total liabilities. While in case of earning based valuation, we have one method called PE ratio based valuation. Well, we will use the formula for the value of the business is the PE is basically the price over EPS. So in order to calculate share price, let's rearrange this. EPS multiplied by price to earning ratio. Another one is called earning yield. The formula of earning yield is EPS over share price. So in order to calculate share price, the formula would be EPS over the earning yield. And we'll use the industry average PE ratio as well as the industry average earning yield. And in case of cash flow based valuation, we have dividend valuation model. The same dividend valuation model that we have used in equity financing, but here we'll use the share price, and that is dividend 1 plus constant growth divided by KE minus G. And sometimes instead of constant growth, uneven growth can be given to you in the question, and we have to then solve this question for share price. Now let's see a few examples. The following question relates to question number 238 to 242. Extracts from the financial statement of Blue Bell, a listed company, are as follows. So we have profit before interest and tax, and then profit after tax, non-current assets, current assets, equity, and non-current liabilities. A similar size competitor company has a price to earning ratio of 12.5 times. This competitor believed that if Bluebell were liquidated, property, plant, and equipment would only realize 600 million, while 10% of receivable would be irrecoverable and inventory would be sold at 30 million less than its book value. Separately, Bluebell is considering the acquisition of D, an unlisted company, which is a supplier of Bluebell Co. What is the value of Bluebell Co on a net realizable value basis? So in case of net realizable value, we have to change the asset value given. For example, the property, plant, and equipment, and the asset size, the property, plant, and equipment realize only 600 million. It's 600 million. And goodwill, this goodwill is internally generated goodwill, and this internally generated goodwill is normally not allowed, but here it is given, so we have to consider this internally generated goodwill as well. So goodwill is 105. Now the next item is inventory, which is 285 given, but the realizable value of inventory is 30 million less than its book value. So here it is 285. So 285 minus 30, it's 265. Receivables 192, and there will be a reduction of 10%. So it's 192 minus 19. Amount that we would realize is 172.8. This is the assets. Now, accordingly, we have liabilities. So total assets minus total liabilities. So we have current liabilities and non-current liabilities. So total liabilities are this one. This one is a total liability 662. So let's calculate the asset value and liabilities 662, and the assets on the basis of realizable values, it's 600 plus 105 plus 265 plus 172.8. It's 1142.8. This is the asset including goodwill. Now total assets minus total liabilities 662. It's 480.8. It's 480.8. As we normally do not consider the intangible assets, so we'll deduct 105 from here, and it will give us a figure of 480.5 minus 105. It's 375. The value is 365. So we have to check the figure again. Property, plant and equipment is 600. Inventory value is 30 million less than its book value. So it's 285 minus 30. It's 255. So 10, deduct 10 from here. So as a result, it's 365.8. So answer is C. Next requirement is, what is the value of the company using the earning yield method? So for earning yield method, we need industry average earning yield and the formula is the share price, or the value is, what is the formula? EPS, or earnings divided by earning yields. So earning, that is after tax profit, is given, that is 150. We have earnings 150. Earning yield is not given in the question. Price to earning ratio is given. PE is 12.5 times. And earning yield is reciprocal of this. So 12.5 times, it's 8%. So value is earning over earning yield. So the value is 1875 million on the basis of earning yield valuation. Next question is, when valuing the company using asset-based valuation, which of the following statement is correct? An asset-based valuation would be useful for an assets stripping acquisition, we want to identify the value of asset. We want to identify the value as per the available assets. The second one is the Bluebell workforce can be valued as an intangible asset. No, it cannot include workforce as an intangible asset. Asset-based valuation consider the present value of future income. It consider only assets and liabilities. Replacement cost basis provides a deprivable value. NRV is provided the deprivable value, not the replacement cost basis. So answer is A, that is asset-based valuation would be useful for an asset striping acquisition. Which of the following is or are indicator of market imperfections? Market imperfections where market is not providing the correct information and the share price is either under or overvalued. Number one says that low volume of trading in shares of smaller companies. That means the suitable information is not available. So it's true. Overaction to unexpected news. Again, this will make the market imperfect. So answer is both 1 and 2. Next is, which of the following statement is correct? D is easier to value than Bluebell because a small number of shareholders own all the shares. Remember, D is the private company. So it's very difficult to calculate private companies' valuation. Bluebell will have to pay a higher price per share to take control of D than if it were buying a minority holding. So this is a correct option. A scrip dividend decrease the liquidity of shares by retaining cash in a company. So in case of a scrip dividend, we are not paying any cash, so it will not affect the liquidity position. D shares will trade at a premium to similar listed shares because it will have a lower cost of equity. There is no valuation method available, so we can't say anything about that. It is what is the value likely, and it is not trade because it's an unlisted company's shares. So answer is B. Another question is GWW Co from 243 to 247. And here we have to calculate the market capitalization. That is also the equity market value. We can calculate this by number of shares multiply by current share price. Second is use the net asset value liquidation basis to calculate the value of the business. Third one is use the PE ratio based valuation. And then we have two theory question. So GWW is a listed company which is seen as a potential target for acquisition by financial analysts. Value of the company has therefore been a matter of public debate in recent weeks, and the following information is given. We have profit after tax from 20X9 to 20Y2. We have total dividend, and we have the asset valuation, ordinary shares and equity, liabilities. The shares of the company have a nominal value of 0.50 and current market value is 4. The business sector has an average PE ratio of 17 times. Let's find out number of shares. Equity value, ordinary shares is 20. Par value is 5. So number of shares are 40 million. Share price is 4. So market cap is number of shares multiplied by share price is 160 million. This is market capitalization. Second one is about net asset liquidation method. The expected NRV of the non-current asset in the inventory is 86 million and 4.2 million. In the event of liquidation, only 80% of the receivables are expected to be collectible. So in the second question, my equity value is 67.2 as per the total asset minus liability value. So the non-current asset, which is 91, now would realize only 86 million, plus inventory, which is 3.8, that would be 4.2 now. Receivables 4.5, only 80% is collectible. So 4.5 into 0.8, these are the assets. 8% bonds, that is 25. So 25 is the liability, and current liability is 7.1. So as a result, the value is 61.7 million. So on the basis of the liquidation method, the value is 61.7 million. And if you have to write in nearest whole number, that would be 62 million. What is the value of the company using the PE ratio based method? Business sector average is to be used. So here value is earnings multiplied by the industry's PE. So the PE is given in the question 17 times. We have to take the earnings. So earning is given. We can use the current earning, which is 10.1. So it's 10.1. And as a result, 17 into 10.1 is 171.7. And there is an answer. We can also use the average earning, but the most appropriate is the current earning. An investor believes that they can make abnormal return by studying past share price movement in terms of capital market efficiency. In case of efficient stock market, to which of the following does the investor belief relates? Abnormal return, we can generate abnormal return by studying past share prices. So if stock market is showing weak form efficiency, no one can get abnormal return by studying past prices. So as semi-strong and strong form, no one can generate the abnormal return using the past, present, and insider information. So if investor believes they can make abnormal return, that means due to technical analysis, they can study the past share price movement and can earn abnormal return. Assuming that the company's P ratio is 15, its competitors' earning yield is 6.25. When comparing company to its competitor, which of the following is correct? So earning yield of GWW and so P is given 15 times. We can find out earning yield 1 over 15, and that is 1 over 15. It's 6.7%. So this is GWW, PE, and earning yield. And the earning yield of competitor is 6.25. We can find out the PE 1 divided by 0.025. So it's 1 divided by 0.062. It's 16.12. So P is 16. Now compare both statements. Earning yield when comparing GWWs to its competitor, which of the following is correct? Earning yield of GWW is 6.7 and earning yield is 6.25. So it's higher in these two options. And price to earning ratio of GWW is 15, which is lower. So we have these two options, higher and lower. So answer is lower and earning yield is let me recalculate it again. Earning yield of GWW is 6.7% and earning yield of the competitor is 6.25%. So earning yield is higher and P ratio is lower. Next question is WAW Co. is an unlisted company that has performed well recently. It has been approached by a number of companies in the industry as a potential acquisition target. Now, this is an unlisted company. The directors are looking to establish an approximate valuation of the company. We need to find out the value of the business. Information is given. We have 20x3456. This is the current year. Earnings, that is profit after tax, dividend. The company has an estimated cost of equity of 12% and 5 million ordinary shares with a par value of $5 million ordinary shares with a par value of 0.50. So that means number of shares are 5.5, that is 10 million. There has been no change in the number of ordinary shares over this period. The company paid tax at the rate of 20%. Listed companies similar to WAW Co have a price earning ratio of 15 times. What is the value of share in WAW Co using the dividend growth model? Now for dividend growth model, the formula is dividend 1 plus G divided by cost of equity minus G. So dividend is given, which is 3 million, latest dividend. Growth rate is not given. KE is also given. So we need to find out the growth rate, and growth rate we can find out the current dividend 3, the previous dividend, which is 2.4, change 1, 2, 3, that is 1 power 1 divided by 3 minus 1. So as a result, we have growth of this one. Put in the above formula. Current dividend is 3 million. 1 plus 0.0772 over cost of equity, which is 12% minus 7.72. So share price is, or the value of the business is 75.5 million. This is the value. Divide by number of shares, you'll get share price, which is 7.55. So answer is 7.55. Which of the following statement are problem in using DVM or dividend growth model when valuing a company? That is the limitation. It is difficult to estimate future dividend growth. Yes, because we normally use the historical dividend rate, but it's very difficult to identify the future dividend growth rate. It cannot be used for unlisted companies as they do not have a cost of equity. This is not the reason. They have a cost of equity. They can calculate cost of equity. It is inaccurate to assume that dividend growth will be constant. Yes, this is correct. It does not adjust for the value of holding a controlling interest in a company. Normally, this model is used for the minority shareholder. So not incorporate the controlling interest. So this is the limitation 1, 3, and 4. So answer is 3. What is the value of WAWCO using the price earning ratio method? Now, it's an unlisted company. So we need to find out a similar listed company's P ratio, which is given as 15 times. Now, in order to calculate the price using the P ratio based method, so it's EPS into price to earning ratio. So we need to find out the EPS, profit after tax, profit 20x6, 7.5 million. It's 7.5 million divided by 10 million multiplied by 15 times. And as a result, the share price is 11.25 per share. A high price earning ratio is usually seen as an indication that the company's earnings are expected to be risky. No. The dividend payout is excessive, is high. No. The share price is overstated. Again, no. The company is expected to grow. High P ratio indicate that there is a potential of growth in the company. So that is, the company is expected to grow. Which of the following statements are true about the company's dividend policy? Shareholder achieve steady dividend growth. The dividend payout ratio is constant. The dividend cover is 2.5. Shareholders are indifferent between reinvestment in the business and the payment of a dividend. Shareholder is not indifferent because of the effect of the taxation. We have to see the dividend payout and dividend cover. We have to calculate dividend payout. So dividend payout. Dividend payout is basically dividend divided by profit. Let's see, first one, it's 2.4 over 6. So it's 2.4 over 6, which is 40%. Try another, 2.6 over 6.5. Again 40%. And we can, if we can check the other one around, the dividend payout is 40%, constant. So answer 2 is right. This is correct. The dividend cover is 2.5. Let's find out dividend cover. So the formula of dividend cover is profit after tax divided by dividend. Profit after tax of 20x6 is 7.5. Dividend is 3. 7.5 over 3. It's 2.5. So dividend cover is 2.5 times. The dividend cover is 2.5 times. So 2 is right. 3 is right. 2, 3. 4 is wrong. So this is not right. This is not right. If 2 is right, so this is wrong. So that means answer is 1, 2, and 3. Now another question. And in this question, we have again valuation on the basis of net asset based valuation, dividend growth model, earning yield. Let's see the question. Profit after tax, that is earnings 66.6 million, dividend 40 million, balance sheet has been given. Analysts have forecast that the dividend of the closed co will grow in the future at a rate of 4% per annum. G is given. This is slightly less than the forecast growth rate of the after-tax profit, which is 5%. The profit growth rate is 5%. The dividend growth rate is 4%. The finance director thinks that considering the risk with the expected earning growth, an earning yield of 11% can be used for valuation purpose. The closed co has a cost of equity of 10% per annum. Calculate the value of closed co using the net asset based valuation. Now here we have simply The historical cost is given. So in order to calculate the net asset, take the equity value, that is 490 million directly. You can take this directly. So it's 490 million. Calculate the value of the company using the dividend growth model. Formula: current dividend 1 plus growth, cost of equity minus growth. Everything is given in the question. The current dividend is 40 million. So 40 million is dividend. Growth rate is 4%. Cost of equity is 10% minus 4% growth rate. And it's now let's calculate. So it's 40 into 1.04. 1.04, and we have 693 million. So it's 693 million. It's 693 million. Calculate the value of the close co using the earning yield method. So for earning yield method, the value is earnings over the earning yield. So earning is given in the question. Current earning is 66.6 million over the earning yield, which is given as 11%, that is 0.11. So for 255, the answer is 605.5 million. 605.1 decimal place. So you can write 605.5. The DGM has been used by dividend growth model has been used by financial analysts to value close co. Are the following statement about the dividend growth model true or false? It is very sensitive to changes in the growth rate. Yes, it is based on growth rate, so very sensitive. It can only be used if dividends have been paid or are expected to be paid. Yes, dividend paid is necessary. If dividend is not given, now we can calculate DGM. Closco is considering raising finance via convertible debts. Which of the following statement is correct about the current market value of a convertible bond where conversion is expected? How we can use the value of convertible bond? Value of convertible bond. So in order to calculate value of convertible bond, we have to identify present value of future cash flows related with bonds. And future cash flows incorporate the interest payment as well as the conversion value if conversion is likely. And we'll use the discount factor, which is the cost of debt. Now, what is the current value given? The sum of the present value of future interest payment plus the present value of the bonds conversion value. The sum of the present value of the future interest payment plus the present value of the bonds conversion value. So what is the difference between the first two one? The sum of the present value of future interest payment plus is the right answer, minus is the wrong answer.